Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. Thank you for listening to the Northbound Wealth Podcast. This is your host, Brent Foster, and today is June 16, 2025. Stocks fell last week as an up and down mix of trade progress and anxiety, economic news, and geopolitical tensions netted out. The S&P 500 index slid 0.39%, closing at 5,976.97, breaking its two-week winning streak though it remains up 1.1% for June and 1.6% in 2025. The Nasdaq Composite Index slipped 0.63%, closing the week at 19,406.83. The Dow Jones Industrial Average declined 1.32%, closing at 42,197.79. And the MSCI EAFE Index, which tracks developed overseas stock markets, edged down 0.18%. Trade geopolitics dominate sessions. That's the headline. Israel launched attacks on Iran early Friday morning, killing Iran's senior-most military leaders. Iran reportedly retaliated, firing missiles towards Israel. Iranian media said its government will not participate in talks scheduled with U.S. officials this weekend. The attacks follow long simmering tensions between the countries. Oil futures jumped more than 7% on Friday after the attack, on concerns that the conflict will curb oil shipments from the Middle East. The week had been upbeat as the U.S. and China agreed to a trade framework following 2 days of talks in London. China will resume rare earth and magnet shipments, though it will put a 6-month limit on shipments in a bid to maintain leverage should trade tensions sour. U.S. President Donald Trump announced the deal pending approval from both leaders. U.S. consumer sentiment jumped to 60.5 in June, significantly exceeding May's 52.2 in consensus forecasts. One-year inflation expectations fell to 5.1% from 6.6%, while 5-year expectations also declined, indicating easing consumer concerns about future price increases. Inflation in May unexpectedly slowed to 0.1% month over month, below the 0.2% Bloomberg consensus, driven by lower energy prices. Annually, the Consumer Price Index accelerated 2.4%, matching expectations, up from April's 2.3% number. All right, so producer prices rose 0.1% in May, the first increase in 3 months, according to the Bureau of Labor Statistics. Last month's rebound fell short of the 0.2% Bloomberg consensus. Most sectors rose this past week, led by a 5.7% increase in energy and a 1.2% increase in healthcare. APA, Halliburton, ConocoPhillips, they led the rally in energy, each climbing over 10%. Halliburton said it was selected by Repsol Resources to support full life cycle of the Spanish company's assets in the North Sea. Eli Lilly in the pharma space was up 6.4%. The company's chief financial officer, Lucas Montarce, said it will only partner with telehealth firms that stop selling copycat versions of its weight loss drug Zepbound. Financials declined by 2.6% and industrials fell 1.6% this week. Okay, so Visa fell 4.7%, while MasterCard fell 4.8% after several companies were reported to be considering their own stablecoins in the U.S. Walmart, Amazon, Expedia, and several major airlines have been weighing plans to launch stablecoins, according to the Wall Street Journal's report. All right, so wide charts. Thank you for some of that information. NMT Newswires, thanks for that. We've got the weekly market insights, major index return summary. Let's start with the S&P 500, which year-to-date trailing number is up 3.4% on the year. NASDAQ is up 2.14% on the year. Dow Jones Industrial average 1.81%, and MSCI EFA index is up 19.32% for the year. Let's see, 10-year Treasury note 4.41%. That's down from the 4.49% a month ago, but still up from the 3-month number of 4.27% and the 4.24% over a year ago. Thank you, Y Charts, for that information. Brighter notes. As the week ended with rising tensions in the Middle East, it was easy to overlook some good economic news. First is inflation. Both the CPI and the producer price index showed signs of cooling or holding steady, and that's actually really good news. And both the CPI and PPI slightly beat expectations. Second, consumers. So consumer sentiment jumped in May. The first such rise in 6 months, economists took note, as consumer spending drives 2/3 of the U.S. economy. So those are good things. All right. This week, key economic data: retail sales Tuesday, industrial production, capacity utilization, business inventories, home builder confidence index, and the FOMC meeting day one. So we'll be paying attention to what they have to say. Jay Powell at the helm of that. Wednesday, housing starts, building permits, jobless claims. Day two of the FOMC and Fed chair press conference on Wednesday. So I'll be following that. Friday, the leading economic indicators. Thank you, IBJ or Investors Business Daily, for that information. This week, companies reporting earnings. No major notable companies. Looks like we've got Haleon, Survival, and Accenture. So there's not a whole lot of companies reporting. Tax tip of the week: what do you do, or what to do if you get an identity theft letter from the IRS? So the IRS can scan tax returns for potential fraud. And if a tax return seems suspicious, they will flag it for further review. In these cases, the IRS will send the taxpayer a letter notifying them of potential identity theft. Because the tax return won't be processed until you respond to the letter, following the steps outlined is essential. The letter will likely have everything you need to know. The 3 different types of identity theft letters that the IRS may send out include: number 1, a letter that asks the taxpayer to verify their identity online; number 2, a letter that asks the taxpayer to call the IRS to verify their identity; and number 3, a letter that asks the taxpayer to verify their identity in person. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. We got a good show for you. Thanks. The Dow, the S&P 500, and NASDAQ Composite have dominated headlines this year, with point swings often used to underscore the volatility that's made many investors uneasy. While these indexes are widely recognized as shorthand for the markets and the broader economy, their backstories are far less understood. How they were built, how they've evolved, and what they actually measure today may surprise you. A closer look at how these indexes have evolved over time can offer a more nuanced perspective that helps contextualize market moves and supports long-term strategy. So, how much do you really know about stock market indexes? That is the question. So where it all started, let's start with the Dow. The Dow Jones Industrial Average. The concept of a stock market index began in 1896 with Charles Dow and Edward Jones. The first Dow Jones Industrial Average included just 12 companies reflecting major industries of the time, like agriculture, coal, and steel. Today's Dow tracks 30 large companies, but the lineup looks completely different. The index has evolved alongside the U.S. economy, shifting from heavy industry to technology, healthcare, and services. Some facts about Dow you might find interesting are: the original calculation simply added up the stock prices of 12 companies and divided them by 12. General Electric remained part of the Dow for over 120 years before being replaced in 2018. The Dow was still price-weighted, meaning a company's stock price, not its total size, determines its influence on the index. It's called a price-weighted index. Okay, so more than just points. Why percentage moves matter. okay? Not just the points, but the percentage moves. Headlines often highlight moves like the Dow drops 500 points, but point changes alone can be misleading. When the Dow was at 10,000, okay, now it's at like over 40. So when it was at 10,000, a 500 point drop meant a 5% decline. So it meant something. With the Dow at around 40,000 today, the same 500 point drop represents barely over a 1% move. So the percentage change, not the number of points, provides a better perspective on market movements. Keeping this in mind can help cut through the noise of daily headlines, like those from The Economist or Bloomberg or something. So the S&P 500, a broader view. While the Dow remains iconic, okay, many investors and economists view the S&P 500, that's including us at Northbound Wealth, as a better snapshot of broader U.S. markets. Updated to 500 stocks in 1957, the S&P 500 includes the largest U.S. companies across 11 sectors, from technology and healthcare to financials. Despite its name, it currently tracks 503 stocks due to multiple share classes. So, a few notable points. It is a market cap weighted index, meaning that larger companies have a greater impact on performance. 5 companies from the original 1957 lineup remain today: General Electric, AT&T, ExxonMobil, Coca-Cola, and Procter & Gamble. The S&P 500 is sometimes viewed not just as a stock market measure, but as a broader economic indicator. That is true. The NASDAQ composite, tech-heavy and fast-moving, okay? The NASDAQ composite, launched in 1971 as the first electronic stock exchange, quickly becoming the preferred home for emerging and technology-focused companies. Today, it tracks more than 3,300 stocks, with technology accounting for nearly 60% of its overall weight. Interesting facts about the NASDAQ. According to the number of listed companies, it is the largest stock exchange in the US. A lot of people don't know that. Major companies like Apple, Microsoft, and Nvidia carry significant weight within the index. The NASDAQ is typically more volatile than the Dow or the S&P 500, largely because of its concentration in growth sectors. Indexes are tools, not strategies. That is very important. It's easy to think of indexes as investment strategies, especially when people say, just buy the S&P 500. But an index is just a snapshot. It doesn't adjust for your risk tolerance goals or timeline. That's why it's important to build a strategy that's aligned with your needs rather than just focusing or following the market itself, the indexes, that is. The bottom line is that stock market indexes like the Dow, S&P 500, and the NASDAQ help us track performance and trends, but they do not provide the whole picture. They give us reference points, but your investment strategy should always be personal and unique to you. I want to thank Britannica Money, Business Insider, for that information. I hope you found this insightful and helpful. Stay tuned for the next segment. Hello, everybody. I came across this article by J.C. Peretz. He's the certified market technician, founder of Trend Labs, and he writes a blog that's called Everybody's Wrong. And I love this article. He has a lot of examples. I'm going to have a link in the show notes to his information, and I just think he's got a wealth of knowledge and insight into technical analysis. It's very interesting, his take. So The Economist is upset again, too. This behavior is consistent with uptrends, and stock and ETF prices are likely to rise from here. So when everyone is piling into the stock market chasing returns, that's usually a sign that things are getting frothy, and we're likely due for some type of correction. To be clear, that is not what is currently happening. Retail investors are selling their stocks. ETF investors are selling into this strength as well, with total equity ETF flows back in the negative. And the journalists out there are still trying their hardest to scare your parents. I'm sure you're shocked to hear, I believe everybody's wrong. That's what he says. I'll just continue on with this article. It's great. retail investors have sold. So Goldman Sachs is out this week with data showing retail net buying and selling for every stock in the S&P 500 over the past month. They've been selling at the most aggressive rate all year. So he's got an exhibit, and again, a link in the show notes to this, of retail investors over the last 3 weeks. That's called the 20-day rolling net flows, daily data in billions since 2024. Some of the net notional or retail buy sell for every single constituent in the S&P 500. And that has trended down. That's what Goldman Sachs has put out there. And when retail is selling this aggressively, it's consistent with the early stages of an uptrend for stocks. ETF flows suggest the exact same thing. ETF investors bought them up this spring only to become net sellers once again as we approach summer. These signs of disbelief are further evidence that everybody's wrong and that stocks will most likely continue to grind higher throughout the back half of 2025. Now, consensus is not that, by the way, you guys. They're saying that we're going to have a slowdown and a sell-off in the back half of the year. That's what a lot of the big banks have put out. Recession, da-da-da-da-da. So let's go on. Journalists trying to be scary. We've talked about how angry media has been and how much they don't like how well stocks are doing. But the best fade of them all is, once again, The Economist. So if you guys ever look at The Economist, he's really highlighting and hitting them hard. I love it. It's great because they're journalists parading around as economists, so you get both. Here are their latest scary magazine covers published over the past few weeks. So he's got these posted. It's great. One of the covers says American Disorder, and it has smoke billowing around the American flag. And the other one is New, Untested, and Dangerous. And it's got a big city, like New York, basically in 4 dimensions on it to be big and scary. So I had a hard time, JC goes on and says, I had a hard time believing that they were willing to fight this massive bull market in stocks. So I actually looked inside the magazine, which is pretty funny by itself, who actually really dives into that, to see if it was just the cover that was scary or whether the article itself was more toned down. Nope, he says. The articles were even scarier than the covers. Meanwhile, the S&P 500 Technology Index closed yesterday at the highest level in its entire history. Funny how that works. He's got a chart of TrendLab's chart that shows the XLK at a new all-time high as well, which is the technology sector. So this is what we are doing here, recognizing when there's a divergence between what they're telling you and what is actually happening. Everybody's wrong. You're literally seeing it in real time. And then journalists hate crypto too. Don't look now, but they're trying to scare you out of crypto as well. Journalists parading around as economists are telling your parents it won't end well. Therefore, we know that it likely will. He goes on to say that it'll end well. So don't believe it. They got this, The Economist has this cover that says crypto meets the swamp, why it won't end well. And it has a picture of the White House and then a swamp with Bitcoin coins floating on top. And JC goes on to say, this isn't hard. We just need to pay attention to what's happening around us. Prices of assets go up. Journalists scare out the retail investors, then prices keep going up. That's how this works. It's when these professional distractors start telling everyone to buy stocks that we want to do the opposite. Remember the stampeding robot bulls published right before the stock market crashed in 2020? And literally he has it. It says Big Tech's $2 trillion bull run. And it's right before the 2020 crash. So JC goes on and say, yeah, that's the kind of thing that would turn us into net sellers. And this ain't it. Stay sharp. By JC Peretz. I love it. It's the contrarian play. When these types of folks are talking about buying or selling stocks, if you almost do the opposite, it's going to work out for you. So don't always believe what you read out there, you guys. All right, on to the next segment. What does the job market look like for 2025 graduates? So those of you who have kids that are graduating, going to go into the 2025 job market, it is graduation season. We just probably had a slew of them across the nation. Okay. So it's a time of celebration and new beginnings. This time can bring excitement and uncertainty for families with college seniors. While some graduates have jobs lined up, others are still navigating job searches anxiously. A degree is a valuable investment, but landing that first job isn't always easy. The class of 2025 faces a unique landscape with the job market constantly evolving. Whether you have a graduate in your life or you're just curious about what's ahead, here's what you need to know about the job market for this year's grads. The job market trends. The hiring outlook for those graduating this year is more favorable than last year, although still well below 2022 data. According to a 2025 survey, overall hiring for the college class of 2025 is expected to increase by 7.3% over hiring for the class of 2024. Among responding employers, 27% plan to increase their hiring this year, while 57.1% expect to maintain their hiring. Only 16% of employers expect to decrease hiring. That's good news for those graduates entering the workforce. The same 2025 survey indicated the starting salary outlook is also trending upward, with 40.8% of employers looking to increase salaries for bachelor degree holders. Over half of employers will offer signing bonuses, the highest level since 2019. So that's really good news. That's the highest level since the pandemic happened in 2020. So does major really matter? That is a great question that I was looking into. And when it comes to landing a job, a major may not be as important as you think. While some technical roles require specific degrees, 51% of employers say they hire graduates from a mix of backgrounds rather than focusing solely on industry specific majors. However, graduates and skills do matter. Nearly 47% of employers now screen candidates by GPA, up from 38.3% last year. So, what are some of the top careers for 2025 grads? According to a 2025 report by Palkus, some are more obvious than others. So, number one, high demand across industries as businesses continue the digital transformation is software developer. Number two, healthcare professionals. So, nurses, doctors, therapists. There's a growing need due to an aging population and increased healthcare demand. Number three, data scientists or data analysts. Companies across sectors use data insights to drive decision making. Number four, cybersecurity specialists. So, increased focus on protecting digital assets and networks. Number five, environmental scientists. So, sustainability and climate initiatives are driving growth in that field. Number six, marketing manager. So, digital marketing, the shift to online and data driven marketing continues to expand opportunities. Number seven, artificial intelligence specialists. So, AI specialists. AI and machine learning are reshaping industries, creating a strong demand for specialized skills. Number eight, human resources specialist. Believe it or not, it's not an AI resources specialist, it's a human resources specialist. Just kidding. Companies prioritize talent management and workforce development. So, beyond the degree, skills matter. Employers are increasingly prioritizing skills over specific majors, meaning that internships, technical skills, and problem solving abilities can be key differentiators in a competitive market. So, preparing for the transition, setting clear expectations around job searches, finances, and independence for graduates moving home can help smooth the transition. More than 30% of young adults now live with their parents, often due to student debt and high housing costs, which is a problem in the United States. So, navigating the job market requires preparation, strategy, and flexibility. Whether you or someone you know is supporting a soon to be graduate, we're here to help with financial strategies that align with their career goals. If you'd like to discuss how best to prepare for this transition or know someone who would find this information helpful, please don't hesitate to contact me. And this information was derived from the National Association of Colleges and Employers. Palcus and Business World and the Earnest blog, all between 2024 and 2025. So thank you for that information. I hope you found this helpful, and thank you for listening to the Northbound Wealth Podcast. Summer vibes with a twist of finance. What's on your money reading list? Whether you're an armchair sociologist or a budding historian, find the perfect beach books for the summer. Dive into wealth history, timeless tactics, strategic thinking, and epic trades. Turn some pages and level up your financial reading. So, what's on your summer reading list? Is it The Millionaire Next Door by Thomas Stanley, where you discover the surprising secrets of America's wealthy? Is it the book by George Clason, The Richest Man in Babylon? Or Thinking Fast and Slow by Daniel Kahneman? Nudge, Improving Decisions About Health, Wealth, and Happiness by Richard Thaler? Or is it Carmen Reinhart who wrote the book This Time is Different, 8 Centuries of Financial Folly? Or the one by Niall Ferguson, The Ascent of Money, A Financial History of the World? Or finally, the book by Gregory Zuckerman, The Greatest Trade Ever, the behind-the-scenes story of how John Paulson defied Wall Street and made financial history. There's plenty more books out there. The Intelligent Investor, Always Be Buying, The Psychology of Money. I mean, the list goes on and on. You can check out our website. I have a book list that has a lot of different topics, but mostly in finance and personal finance and investing. Another great one is Managing God's Money. And that one's a good one from a faith-based perspective. So check it out. Check out the website, but also pick up some books this summer. Learn something new and stay tuned to the Northbound Wealth Podcast.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.